When you look at the stock market performance, they seem to be okay with the deal. How long can it last?
Yeah, well, look, I think it is important to step back and appreciate that this is a very big deal. It's very significant. It's, I think, been surprisingly close to the initial proposal, and it's happened quite fast. I mean, even though I felt, our call at Morgan Stanley was quite optimistic around the deal getting done, we still thought there was a good chance it might take kind of a second session, to kind of finally wrap things up. So the fact that they did it in this round is good news. And I do think it's helpful to the European story, where European assets have lagged for a long time, where they're generally cheaper. And so I do think that we can see some sustainable outperformance from the euro, from European equities here over the coming months. I think the bigger concern is that, this is one of several positive things that's happening in July, along with earnings season, along with maybe another U.S. fiscal package. Once we're out of July, those positive events are behind us. And so I think I'm more concerned in that August-September period, what's going to be then the next catalyst to take kind of the broader market higher.
Yeah, and Andrew, you basically argue that over the next 2 months, the positive catalysts fade, there's seasonality getting worse, and near-term risks emerge. What does that all mean for stocks?
Yeah, so I think it means a tougher period for stock markets. So there's that old saying, which is a great saying, that it's better to travel than arrive, and I do worry a little bit that as you're into August, you've arrived with a number of these factors that we're having a pretty good earnings season now, but that will be behind us. We've had a very successful European summit, but that will be behind us. That we do think that the U.S. will pass another round of fiscal stimulus around the end of the month. But again, that will be behind us. And even I think some of the good news on vaccine development, which is certainly very encouraging. Again, the kind of the phase 1 data will be behind us, and it will be some time while the market has to wait for what are the results of the phase 3 trials, which we think might not get until sometime in October. So it's that kind of gap in news at a time when we do think there's some rising risk that some of the economic data momentum softens a little bit, and that you're into a period where, at least for U.S. assets, kind of August is when you can often start to see some worsening kind of pre-election performance, that the market starts to care more about the U.S. election. It's harder for people to take on new investment ahead of the election, and I think a lot of investors just decide to wait until they know the result before making their next investment.
So what are your top picks, Andrew? Where do you find value from here? What kind of strategy should we be looking at, given that, I guess, some of the safer stocks are also look expensive?
Well, I think that's a great point. I think complicating this, I would love to say, that we're the only ones who are concerned about, a slowdown in growth. I think the market's very concerned about a slowdown in growth. I think you see that in where bond yields are. I think you see that in where volatility is. I think, exactly as you mentioned, I think you see that in how much a lot of these defensive stocks have outperformed. So it doesn't, I think, do a lot of good to try to hide in those places that are already very, very expensive. I do think Europe on a cross-asset basis is a very appealing place to hide out. I think that I do think this recovery fund it's here. It's going to be here for a while. I think it provides a bit of a halo around the region. Valuations in Europe are very reasonable. You don't election-related risks. I think also cash corporate bonds have a very positive dynamic behind them, in that you've had very heavy issuance of this debt from April through now, as companies have kind of rushed to grab financing while it's available. We think that now slows a lot, and so you'll just have far fewer bonds coming into the market, which could help some of that performance and some of that supply-demand imbalance in the corporate bond market.
Andrew, do you buy what central banks buy? Is that still a good strategy?
I think in credit it is, because I think there again you could have this kind of dual dynamic of the central banks are supporting the markets and providing a backstop to the market, and supply is then slowing down. But I think the tough thing there is, I think if we look at, say, the government bond side, central banks have already pushed real yields down to record low levels. That obviously, I think, reduces the risk reward, And, I'm actually very curious because I think it's actually very hard to tell where expectations are for the Fed meeting next week. And I think that, we don't expect the Fed to announce any major new action at that meeting. That's our expectation, but I think investor expectations are actually quite varied about what they're expecting. And so to the extent that if they don't do anything, does that come across as actually a little bit of a disappointment is, I think, a kind of a big unknown.